Your financial advisor might be robbing your retirement account, and it's only happening 1% at a time, so you don't even notice. Now, hiring a financial advisor is what smart people do with their money, especially once you start making more money. But the truth of the matter is, the fee structure with how financial advisors charge you could eventually eviscerate your retirement and take out hundreds of thousands of dollars of potential returns. And in fact, I'll even show you the math today of how it could potentially even cost you over $1 million in your future retirement. Now, listen, this video is not anti-advisor, but I want you to go into the relationship with your eyes open and see what it could be costing you if you decide to outsource managing your investments. All right, first things first, let's break down how financial advisors might get paid. Now, there are a few different business models that financial advisors could use. So some financial advisors charge hourly, and this could be anywhere from $150 an hour to $350 an hour or more, depending on the situation. Some charge just a flat fee for an entire financial plan. This could be anywhere from $2 to $4 to $5 up to $10,000, depending on the complexity of the financial planning involved. Others do get paid on commission, but that's usually in like the insurance space or annuity or whole life insurance, that type of stuff. The most popular payment model for a financial advisor is what's called the assets under management fee, or the AUM. What they do is they charge a percentage of the total assets that they're managing for you. So the total of your Roth IRA and your retirement accounts and your brokerage and everything that's under their control, they will take a small percentage of that. And in the industry, it's typical to charge between 1 to 1.5% of your total assets under management, again, depending on the size of your balance and their business model, all that stuff. Now, for that fee, what do financial advisors actually do for you? Now, what they're supposed to be doing is building and modeling asset allocations for you and talking about investment risk and building a portfolio that you can invest in that's balanced. They should be able to do tax and estate planning, or at least have somebody that they can refer you to and think of those things in mind as you're investing. They can do budget coaching and money management and talk to you about different types of insurance to make sure you're fully covered. And they can check in with you regularly to make sure that you're moving toward your financial goals. The problem is, and the problem that I've seen, especially with my coaching clients, is a financial advisor will create a little portfolio based on their financial advisor software. It's a bunch of mutual funds, and then they will just dump the money in there and not really do anything, don't give them any feedback, and maybe once a quarter they'll send them an email. That's about it. And they're charging them a 1% assets under management fee for that. Now, how can this 1% fee impact your retirement? Well, there's a couple scenarios I want to break down, and then I want to share with you a free tool that you can analyze your own investments and the impact of this fee. So scenario number one, let's say you decide to put that $500 a month away into a Roth IRA account and you earn about an 8% return over the next 30 years. That would turn into $682,000. Woohoo! But what if you decide to just outsource it and you go, you know what, financial advisor, please open my Roth IRA for me, invest for me, go get that 8% return. I don't want to think about it. You would end up with about $566,000. That would cost you $116,000 in returns just from that 1% financial advisor fee in that one account. Now, let's bump that up to $1,000 a month for 30 years. Let's say you have a higher paying job and you're able to put that money away. And again, you hire that out to be managed. If you don't hire it out, $1,000 a month for 30 years is $1.36 million. But if you decide to just let your financial advisor take care of that, it turns into $1.13 million. That's a $230,000 cost just for that 1% fee because you didn't want to invest for yourself. That's real, actual money lost for retirement. Now, let's say you have a $100,000 lump sum and you're like, I need to put it somewhere, and you decide to invest it for yourself. And again, you get that 8% and you let it sit for 30 years. You'll have $1 million more in retirement if you do that. But let's say you hire a financial advisor and you pay them that 1% fee. And let's be honest, in a more likely scenario, they put you in some higher cost mutual funds that don't quite perform as well, and you only get a 7% return instead of 8%. You would end up with that 1% fee and then a 1% lower return would end up with about $761,000. That's a $250,000 opportunity cost, again, because you decided to outsource your investing of this lump sum of money. Now, even worse, let's say you let that money grow, and then by the time you want to retire, you have $1 million put away. But again, you have that financial advisor, and they're taking 1% of your money every single year. So that's $10,000 right off the top there. But the worst part is, If you have $1 million and let's say you're going to live on the 4% rule, you can withdraw 4% of your total assets. So you could pull out $40,000, but the first 10,000 goes to your advisor. You just lost 25% of your retirement income, again, because you're outsourcing your investing. All right, and I promised to show you a free tool that will allow you to look at your fees in your own and retirement accounts. Here it is. It's called Empower Personal Dashboard. Now, I've been using this tool for over a decade, back when it was called Personal Capital, but it's a free tool where I connect my investment accounts and it gives me all kinds of tools and analysis. But my favorite tool on this entire platform is called the Retirement Fee Analyzer. Now, this retirement fee analyzer can be found under this planning section. Just go down to Retirement Fee Analyzer. And when you open it up, you're going to be able to see a couple of things. Number one is your list of contributions, the total earnings on your retirement, and then the total fees. Okay, so here's how you get to these numbers. Number one, there's this annual contributions slider. You can put in how much am I investing. So I just did an example of investing about $1,000 a month, about $12,000 per year. And then let's just say you get about a $4,900 employer match, like in your 401k account, for example. And then annual growth, I've set it to all the way at the very top. They don't let you go past 9%. That's the estimate. The stock market has averaged around 10 or so over the last 100 years. But if you scroll down, you can see all of my Roth IRA accounts that I've connected are all in VTI. They're all in the total stock market fund. So they're going to average 9 to 10%. So I put that slider up. And then no additional investment fees. Now, here's the breakdown. Over my lifetime, there's about maybe 100,000 between these three accounts. Plus my additional $1,000 a month contributions. Over the next 28 years, I'm going to contribute a little over $800,000. That's a good chunk of money. But check this out. I'm going to earn over $2.8 million. I'm going to earn $2 million more than I even contributed, which is insane. So my retirement will be close to around $3.6 million. And out of all of that money, I'm only paying around $20,000 in fees, because as you scroll down here, you can see my index funds have insanely low expense ratios, 0.03% per year fees, but it's still $20,000. It's not nothing, right? That's more than a cup of coffee. But if you hire a financial advisor and you're going to pay that 1% fee, watch what happens. So they have this slider here called additional investment fees. And watch what happens when I slide this up to the 1% mark. So if you're paying a 1% fee to an advisor, wow. Instead of paying $20,000 in fees over your lifetime up till retirement, you're now paying $647,000 in fees. Now, how can that be? How can 1% turn into $650,000? Well, it's easy. That 1% compounds. That's 1% less money every single year that you have invested in the market, 1% less that can grow at that 9% clip. So now it's like reverse compounding. It's like negative compounding. And over time, as your portfolio grows to $1 million, now you're paying $10,000 a year to this advisor. Now it's $2 million. Now you're paying $20,000 a year to the advisor who's probably just doing the same thing. And these fees absolutely destroy your earnings. Before we were at 2.8 million, now we're at 2.2. Now, again, you're still close to a $3 million retirement. You might be thinking, that's fine. I don't care about losing. I don't know who would say this, but maybe you don't care about losing $600,000 to an advisor. It actually is worse than that, because most financial advisors are going to put you in a more diversified, balanced portfolio. What that means is they're going to put you in high-cost mutual funds that typically underperform the market. So these high-cost mutual funds, and I will say this because I've seen this with my clients, I've seen this with my family and friends, anybody that I've helped look at a managed account, they're in a wide range of mutual funds and they're paying way too high of expenses. Now, these fees can range from 0.5% up to 1.5%, but let's just do a conservative 0.75% increase between all the mutual funds you get put in. So now you're paying 1.75% in fees, and look what just happened. You just lost $1 million in your retirement. If you were, starting at $100,000 and putting $1,000 in a month, you lost $1 million because you decided to hire a financial advisor that puts you in high-cost mutual funds and charged you on top of that another 1% assets under management fee. It's absolutely insane. Like, it's unfathomable the amount of money you can lose with just hiring an advisor. And I'm not saying all advisors do this, but some that I've seen, many that I've reviewed portfolios for, have this type of setup. But it's actually even worse than this. It's more than $1 million because those mutual funds don't get 9% per year on average. They're balanced. You've got a lot of fixed income and some real estate stuff and some crazy balanced actively managed funds that are trying to do something that you don't need it to do, and you actually earn less than 9%. It's probably closer to 7.5%. But let's say, your advisor is pretty good and earned you about 7.8%. check this out. You don't pay as much in fees, but you know why? Because you earn way less. We just went from $2.8 million in earnings on top of your 800 grand of contributions to 1.3 million. 2.8 to 1.3. That's $1.5 million difference because you chose to outsource your investing. I don't know how else I can emphasize how important it is to understand investment fees and why being able to manage your own money, invest for yourself, and build a portfolio and understand how it works can change your entire life. So now the retirement, again, still gets you to $2 million, but you're giving up $800,000 that to an advisor who's underperforming the market and putting you in mutual funds with high fees. So if you want to see what is going on in your retirement accounts, please click the link below. Sign up for Personal Capital, aka Empower Personal Dashboard is what it's called now. Connect your retirement accounts to this and see what it says. And even if it doesn't pull your advisor fee in, take a look at the expense ratios of those mutual funds that you're in. I guarantee if they're not index funds, they're not 0.03%. And then if you go to your advisor and ask how much they're charging, maybe they're charging 1.25%, right? I've seen this before. You're still losing an insane amount to fees over your lifetime compared to if you get your own investments. It's just a massive chasm of difference. So hopefully that piece was helpful. And again, if you want to try Empower Personal Dashboard, I have a link below. You can sign up for free, connect your accounts, and analyze your own retirement accounts. Okay, you're convinced you don't want to hire a financial advisor, or if you have one, you're considering managing your own investments. So what should you do instead of working with an advisor? I would say all you need to do is take a couple of simple steps, invest in index funds, and just ignore everything else. Here's what I would do. If I had $1,000 a month to invest and I wanted to move forward, number one, I would fire my financial advisor. I will tell you I did this, and I might share the full story at some point, but I had Edward Jones for 9 years and they ripped me off terribly. And it took me a long time to understand that they were destroying my financial future, and I moved on from them. I just moved everything over to Vanguard. It was super simple. But once you do that, what do? Well, I would just start investing in tax-advantaged accounts to grow your wealth. So this includes first putting money in your 401k, especially if you have a match at work. So let's say you put in 10 grand and your company will match 50% of that. They put in 5 grand. That's 5 grand of free money every single year you do that. That's an immediate 50% return on investment. And then the money lowers your taxable income and gets invested in index funds and grows. It's a no-brainer. The 401k with a match first. Then, if you have extra funds, you put it into a Roth IRA. The reason I like the Roth IRA is it is a very flexible retirement account. What I mean is you can put in 7 grand a year or 8 grand if you're age 50 or older, but that 7 grand is a principal investment. It's counted as your principal investment. You could pull that money back out at any time with no taxes or penalties from the IRS. You can't do that with any other retirement accounts. You can pull that money out if you need to. Again, backup emergency fund. But if you're in a pinch and your original investments, because they're not tax deductible in the year that you put them in, you could pull them right back out. But the better part is don't touch that money and actually let it grow in the Roth IRA. It grows tax-free, and by the time you want to retire, you can withdraw funds from your Roth IRA tax-free. So you could build a $1 million Roth IRA over the next 20 to 30 years, and then you can pull that money out tax-free in retirement and pay nothing. It's pretty incredible. So I love the Roth IRA. Now, if you have access to a health savings account, that's sort of like my sneaky second favorite account, because if you have a high deductible health plan at work and you open an HSA, a health savings account, the money that goes in is tax deductible. You could put it in index funds, let it grow tax-free, and then you could pull it out tax-free like a Roth IRA when you use it for medical expenses. So it's got a triple tax advantage to it. Now, if you have access to one of those, I would probably even max that thing out before your Roth IRA because of that triple tax advantage. But either way, between your 401k, Roth IRA, and HSA, you could easily put $1,000, maybe even $2,000 a month away between all those accounts, protect it from taxes, and then just let it grow tax-free in the meantime. Now, what should you be investing in? That's the key. If it's not all these myriad of mutual funds, what is it? You're going to want to build a portfolio that makes sense for you. But if you're younger, just putting a majority of your income into a total stock market or S&P 500 index fund like Vanguard's VTI or VOO makes so much sense because you have a long road ahead of you. You have a lot of time to let that grow. And yes, it's a bit more volatile. It'll go up and down with the stock market, but you pay almost nothing in fees. You own all the top companies, and it just grows along with the market. You're not trying to beat the market. You're just trying to be the market. Now, if you want more hands-off investing, you could buy what's called a target date fund. Now, these funds, again, have very, very low fees, but they own a mix of US stocks, international stocks, some bonds, some international bonds, maybe some US treasuries. It's a balanced portfolio based on when you want to retire. So if you're going to retire 35 years from now and it's 2025, you're going to get the 2060 target date retirement fund. So you just go to Vanguard, Fidelity, Schwab. If you just look up, Vanguard 2060 fund, it's going to be pretty aggressive. It's going to be mostly stocks and very few bonds. But as you grow through your career and you get closer and closer to retirement, that target date fund is going to start switching to more bonds. Maybe it turns into 10% bonds, then 15, then 20% bonds. So it automatically adjusts for you. So it's almost like having a managed account, but you're paying 0.08% in fees. It's a no-brainer. So again, if you want even more hands-off, you can consider something like a target date fund. And then bottom line is you max out your tax advantaged accounts, you invest in like index funds or target date funds, and then you automate the process. Now your 401k and HSA, that comes straight out of your paycheck. You don't even see it. It's amazing. Now, if you're going to do a Roth IRA, that's outside. You have to go open it yourself, through Vanguard or Schwab or Fidelity, one of those three. And you're going to need to set up a recurring investment. I recommend figuring out how much do I need to invest per month to max it out. So if it's $7,000 for the year and you got 7 months left in the year, just put $1,000 a month into it. If you're starting in January, just put $583 a month, and that'll be $7,000 by the end of the year. But hands-off investing is the best way to invest. And then turn off the financial news, unsubscribe from all the financial newsletters, and just ignore anything that's telling you about the stock market crashing all the time. Like, yes, there's ups and downs, but long term, you're investing in growth. You're investing in companies. There are hundreds of millions of people that get up to work every single day for you, the investor. So just ignore the noise. All right, that was a long rant about 1% fees, and I hope I've convinced some of you to just invest for yourself and stop wasting potentially hundreds of thousands or even $1 million impact in your future retirement. But financial advisors have a place, and there's a time where you're going to want to use them. So, for example, if you have a huge transaction coming, you won the lottery or you have an inheritance, you're not sure what to do, you're going to want a financial advisor to help you navigate that. Or maybe you're nearing retirement and you're like, what's the optimal withdrawal strategy for my retirement accounts? That's a great time to pull in a financial advisor. Or maybe you just want some estate planning help or tax planning help, something strategic, or you have a higher income and you're like, I just need some help with this stuff. I would say a financial advisor has a place, but don't let them manage all your assets for you. Just hire them for their advice. There are advice-only financial planners that will charge you maybe $150 to $300 an hour, or even a couple grand for a comprehensive plan, up to $5,000. But they're not trying to manage your money for you. They're the professionals that are going to guide you through exactly what to do, especially in those types of situations. And I'll say the one place that I send people nowadays is called Nectarine. So my buddy Jeremy over at Personal Finance Club on Instagram, just look him up. He's a massive Instagram finance creator. But what he did is he actually built this platform where the financial advisors that use this platform as a referral network can only be paid by the hour or a flat fee. They don't charge assets under management. They don't charge that 1% fee that could cost you hundreds of thousands of dollars. They just give you financial advice. They don't manage your money, don't sell any products, they're not earning commissions, pay for just the advice. That's what I love about this platform. So again, if you go all the way down to the pricing here, you can see it's $150 to $300 per meeting, or $2,500 to $5,000 per plan, one-time fee, and then they'll break everything down for you. So if you have one of those big life transition things happening in your life, I would go over to these guys and see if you can work with a financial advisor that's not going to manage your money for you, but give you true, detailed, specific financial advice. So if you have one of those big life events, hiring somebody like the folks at Hello Nectarine and working with a flat fee or fee for advice financial planner could make sense. Now, if you want to go the DIY route, I've got a ton of other people that want to do that as well. And so you can join us in the Freedom Investing Club. I created a private community where we talk about all this stuff, where we talk about financial independence and planning and strategies so you can retire sooner, so you can make smarter investing decisions. You can just click the link below or go to roadmapmoney.com/club and you can join us there. I've got my free retirement calculator in there and my Coast Fire calculator. I've also got my 10 steps to financial freedom that will break down the optimal order of where to put your money when, and I'm going to be in there, so feel free to ask me any questions. And listen, I don't want to rag on financial advisors. I'm not trying to say they're all bad. Trust me, I have friends that are financial advisors, and they're the most wholesome people that want other people to win and that I would trust with financial advice. But I would say for a majority of people, especially if you're in your growth phase, a financial advisor just doesn't make sense. And if you continue to use a financial advisor instead of getting financial educated yourself or working with something like a financial coach or a flat fee for advice financial advisor, if you're just outsourcing your retirements, then you're going to end up paying hundreds of thousands extra, and you might have to work an extra 5 to 10 years just because you're not stepping into figuring out how this stuff works. So I hope that motivates you to at least just learn a little bit more. Feel free to browse my YouTube channel. I try to share as much of this stuff as I can. And again, you could join the Freedom Investing Club if you want to jump into a community of like-minded people that are working toward early retirements and hitting that coast fire milestone. Thank you for being here, and I will see you in the next video.